Hello, welcome to Tax Talks with JRBT. I'm Angela Ragan, a partner in our tax department, and with me today is Kraig Fields, another partner in our tax department. As we approach the end of 2022, we are reminded of the increase in interest rates and inflation that has affected many individual taxpayers. Now is the time for us to recap a few items to help with year-end tax planning. We will take the next few minutes to highlight a few tax items. But before we begin, I need to state that this is not meant to be tax advice. Please contact your tax advisor for additional information for planning. Let's jump right in. There is a slight increase in the income tax brackets for 2022 to 2023. The tax rates themselves aren't changing. There still remain 7 tax rates ranging from 10% to the highest marginal rate of 37%. However, the starting and ending dollar amounts in each bracket were adjusted to help prevent taxpayers from being pushed into a higher tax bracket due to inflation. Taxpayers should be aware of their anticipated tax bracket. Now, long-term capital gains are taxed using a different bracket in rates than ordinary income. Long-term capital gain rates for 2022 and 2023 remain at 0%, 15%, and 20%. Remember, there is an additional 3.8% net investment income tax that applies on your net investment income for those in a higher income bracket. Taxpayers should plan accordingly and adjust the timing of those capital gains and other investments if possible. Now, what we have seen is that more and more taxpayers are falling into taking the standard deduction rather than itemizing. Let's talk a little bit about those changes in the standard deduction for 2023. The standard deduction for married couples filing jointly for 2023 rises to $27,700. This is up $1,800 from the $25,900 standard deduction in 2022. For single taxpayers and those who are filing married, filing single, their standard deduction also increased by $900 and head of household increased by $1,400. This is a good time to plan the timing of your income and deductions between the two tax years. Kraig, can you talk a little bit about that?
Sure. One of our standard typical type of tax planning moves is to moving of income from one year to the next or deductions from one year to the next. If we think we're going to be in the higher tax bracket this year than next year, we'd like to push income to next year when it's going to be taxed at a lower bracket. The deductions, if we're in a higher bracket this year, we want those deductions to fall in this year. And so we try to get our extra deductions in this year. That might be bunching of donations to where you're giving not only this year's, but prepaying next year's donations in December, so that you're doubling up and getting a double value this year. That might also push you above the standard deduction amount as well, so that you actually get some benefit for those donations. Other things that you might do relate to capital gain transactions. You might, if you've had some realized gains this year, you'd be in the minority probably. Most folks had losses this year, but if you had some capital gains, what you'd like to do is perhaps harvest some losses that you probably have there in order to offset those gains so that you zero them out. You can also take your dividends if you're a closely held company and push those dividends timing, whether it be a better year this year or a better next year, push them into January if you want to. So that's kind of the things that you can do with regards to your timing of your income and your deductions. So Angie, talk to us about donations.
Yes, cash contributions made to qualifying charitable organizations has changed from 2022 and 2023 to compare to what they were pre-2022. This change in the previous tax years was in response to the COVID-19 crisis. So in the prior years, the percentage limitation on cash contributions were temporarily suspended for qualified charitable contributions made after 2019 and before January of 2022, meaning that they were limited to 100% of taxpayers' AGI. But for 2022 and 2023, that temporary suspension on the AGI limitation has ended, bringing the contribution subject to a 60% of AGI limitation. What this really means is that the increase in standard deduction now says you have to give more in order to receive a tax break. You don't deduct charitable contributions unless you itemize on Schedule A. To do that, all itemized expenses must exceed the standard deduction. With the real estate taxes and sales tax or state and local tax limited to a $10,000 deduction, only a minority of our taxpayers are itemizing. That means that if you're planning to make a year-end gift for qualified charitable contributions, you need to be mindful of the AGI limitation that comes into play this year. So that charitable contribution deduction is now limited to a 60% AGI limitation. Now, there may be some other things that you can do. Kraig, can you talk to us a little bit about that?
Sure. So for those of you that are taking your RMDs from your IRA, so you're 70 and a half or 72 or older and having to take money out of your IRAs, there's probably a more efficient way for you to make your donations. So you tell your custodian that you want your donation to go directly to whatever charity of choice that you have, and that will reduce the taxation of your distribution. So in effect, you're basically getting 100% deduction, even though you're not itemizing your deductions. So it's probably one of the better ways for those folks that are having to take out RMDs, use a portion of that, up to $100,000 can be done to charities, and it reduces your taxable income. What are some other retirement plans? One of the other things that we do in tax planning typically is retirement plans. You need to know that your 401ks and your 403bs, fully fund those the most that you can. Right now, that's $20,500 in 2022, up to $27,000 if you're over 50, and that's increasing this next year to $22,500 and to $30,000 if you're over 50. A couple other things with IRAs that you can do. You can actually take out $5,000 penalty-free from an IRA, even if you're under 59 and a half, to help with the expenses of childbirth or adoption. Up to $10,000 if you both have IRAs and it's on a married filing joint return. Another thing that the Secure Act did was it allows folks over 70 and a half to actually continue funding IRAs if they have earned income. Then the next thing we want to talk about was kind of a thing that was a little confusing this last year, and that's on inherited IRAs. So if you were the beneficiary of an inherited IRA, the new rules say that you have to take those monies out within a 10-year period. You don't get to put it out over your full life, your expected life. It has to come out within a full 10-year period. But there's still questions as to if there's required minimum distributions during that 10-year period. The IRS has come out and said that they believe that there are, but they're going to give waivers for 2020, 2021, and 2022. So if you didn't take them out, don't worry about it. There is no penalties. They tell us that they're going to come out with the final regulations in early 2023, and then we'll know what we have to do from 2023 forward. But do know that it all has to come out within that 10 years of being inherited from the decedent. One other thing that we want to talk about was the gifting exemptions have been increased a little bit this year. They've went up to $16,000 for 2021, and they're going to be going up to $17,000 for 2023. So if you're making gifts to kids or grandkids, know that those are the limits. You can also do, in addition to those, you can pay directly for any medical expenses or directly for tuition, private tuition or college tuition, etc., in addition to those limitations. So Angie, anything else that we need to talk about? It's about time to wrap it up.
I think you've covered it all, Kraig.
All right. Well, we appreciate you folks watching today. And this is going to be Kraig Fields and Angie Ragan signing off to the Tax Talks this year. And y'all have a great holiday season.
Thank you.